What is going on, YouTube Nation? This is Dark Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So I'll tell you something funny. So I have to take a urine tox screen for my rotations. And literally, I was in line, pacing back and forth like Darth Maul, like right by the LabCorp door. Like, I gotta go. I gotta pee. I gotta get this over with. Shall be fine. And they closed. Like, oh, we're on break. Well, we'll come back in 2 hours. So it's like, oh, 10 minutes, like pacing back and forth trying to pee. And then they tell you that they're on break and come back in 2 hours. So now I'm going to finish this video and I have to go back and do my urine tox screen. So you guys wanted me to do a review on two dividend stocks. Two of them I actually own, I'm long on. And I'm going to buy these guys like crazy. Another one I just added to my M1 Finance dividend portfolio. And all three of these dividend stocks have an 8+ dividend yield. So, these guys have high dividend income. I'm going to explain to you guys why I'm buying them. And I'm going to provide my rationale. So I'm going to go over the revenue, the dividend history, and show you guys why they're in demand. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. Smash that like button. And let's check these stocks out right now. And due to popular demand, again, I'm going to do a video on Arbor Realty Trust, and I'm going to explain to you guys why I'm long in these guys and why I'm buying more. And I want to get to 400 shares of these guys. I made it to 200, but I think it's time to kick it up a notch and get to 400, and I'll explain to you why. They're sitting at 1502. Dividend yield is 10.12%, a PE ratio of 7.71. Average volume is 2.86 million. The market cap is 2.41 billion US dollars. Year range is 1218 to 2074. The day range is 1463 to 1502, and its previous close was 1489. So, what do I like about these guys as a mortgage-backed real estate investment trust? Well, first of all, they're actually doing very well against the S&P in the past 5 years. So, for a mortgage-backed real estate investment trust to do very well against the S&P, that's very surprising. You see, like mortgage-backed real estate investment trusts like AGNC. You see NLY, they're not doing too well against the S&P, and they haven't hiked their dividend. So I'm going to go over these guys real quick. Arbor offers a total nationwide solution for your multifamily finance needs, including Fannie Mae, Freddie Mac, FHA, bridge loans, among many other flexible options. So here's what they offer. And again, these guys are a mortgage-backed real estate investment trust. Small loans, CMBS, preferred equity, single-family rental, Freddie Mac, bridge loans, FHA, multifamily, senior housing and healthcare, which I think is very diversified and huge, green financing. So all of these together make these guys a very powerful mortgage-backed real estate investment trust. So I'm going to go with their revenue and their dividend history right now, which is like phenomenal. Again, revenue-wise, these guys are doing phenomenal. It's very rare to see a mortgage-backed real estate investment trust do really well and increase their revenue over time. And again, this is not financial advice for entertainment purposes, only disclaimer in the description. But I absolutely love these guys with their revenue, and this is why I'm buying more. So 2015, this is in millions US dollars, 142, 2016, 213, 2017, 346, 2018, 484, 2019, 535, 2020, 603, and then 2021, 799. So there's a huge increase in revenue. Remember, real estate investment trusts, 90% of what they make have to go back to investors. That's part of the rules that define them as a real estate investment trust. Same with a business development company. Let's check out their dividend history. Let's start in 2012. I'm on Zacks.com. 8 cents, then 10 cents, then 11 cents, then 2013, 12 cents. Then they cracked 13 cents. A little stagnant, 13. Then all of a sudden, 2015, they cracked 15 cents. 2016, they were 16 cents. 2017, then they cracked 18 cents. Then 2017, 19 cents. 2018, 21 cents. Then 25, then 27 in 2018. Then you have a little special dividend right there of 15 cents that they added on January 1st, 2019. And then they cracked to 27 cents in 2019. 2019, then 30 cents. And then 2020, 31 cents. Then 33 cents, 34 cents, 35 cents, 36 cents in 2021, and then 37, then 38 cents in May of 2022. So, number of dividend increases in the last 5 years is 16. Dividend growth in 5 years is 14.48%. If you bought one share, you made 152. Right now, the dividend yield is 10.21% with a payout ratio of 75%. So this is why I want to get to 400 shares and then just reinvest the dividends and earn that passive income. So once I start making $100, $200 a month with these guys, I'm going to be very excited. Let's jump to the next dividend stock. And that next one is Magellan Midstream Partners. MMP is a symbol. It has a dividend yield of 8.39%. I just added this on my M1 Finance dividend portfolio. PE ratio of 11.62, average volume 1.19 million US dollars. Market cap is 10.47 billion US dollars. Its year range is 43.58 to 53.75. Its day range was 48.73 to 49.66. Its previous close is 49.77. So in the past 5 years has not done hot against the S&P. But watch this. Since inception, it was up at one point. So let's look at these guys as a stock from the get-go. 2010, they were 1638. They jumped up in 2015 to 86.19, and they're way down right now at 49.47. So that's one thing that's very attractive. And right here, when you see that pandemic hit, they dropped significantly and people are buying the dip. So right now, it's a deal, and this is why I bought it. So I'm going to go over these guys real quick, and I'll go over their revenue and dividend history. So Wikipedia is making life a lot easier for me. So MMP is a publicly traded partnership based in Tulsa, Oklahoma. It owns ammonia and petroleum pipelines in the Mid-Continent Oil Province. According to the United States Department of State, it owns 83 petroleum products terminals, more than 9,000 miles of refined products pipeline, 800 miles of crude oil pipeline, and 1,100 ammonia pipeline system. It is listed on the New York Stock Exchange. Company executives, including its CEO, Michael Mears, rang the NYSE bell on February 8th, 2016. So this is not Jim Cramer running the bell. This is actually a guy that has done very well with a company and is the CEO of a company. So let's jump to their revenue real quick, and then I'll go over their dividend history. Let's just start 2015. This is in millions US dollars. 2001.88, 2016 2,205, 2017 2,507, 2018 2008.26, 2019 2,600. Big deal. 2020 2,322, and then 2021 2,733. So there isn't a hike in their revenue from 2015 to 2021. Now let's check out their dividend history. Let's start in 2011. It was 80 cents, and then 2012. By the way, you have to pay a K1 on this one. 2012, it was 82 cents and 84 cents. And you got this 47 cents and then 49 cents in 2012. 2013, 50 cents, then 51 cents, then 53 cents, then 56 cents, then 59 cents in 2014, and then 61 cents, 64 cents, then 67 cents in 2014. 2015, then 70 cents and 72 cents, then 74 cents, and then 76 cents in 2015. 2016, 79 cents, then 80 cents. And then 2016, you get 82 cents, 84, 86, 87. 2017, you get 89 cents. Then you get 94 cents in 2018, and 96, and then 98. Then you crack $1 in 2019. Okay, $1, and then $1.01 in 2019. Then you cracked a 102, 103 in at the start of 2020. Then you're still at 103 right now in 2021, and then 2022 they just cracked 104. So the payout ratio is 87%. Number of dividend increases in the last 5 years is 12. Annualized dividend growth in the past 5 years is 3%. So if you bought one share, you made $4.15 with the 8.34% dividend yield. I'm going to go over a few more things with these guys. Why did the dividend and the price go down? So they did a stock split. They have a stock split history in 2005 and 2012. They did a 2-for-1 stock split. So that's one thing that's very interesting with these guys, and this is what attracted me to them, is they have a tradition of splitting their stock and hiking their dividend. So we're going to go over to one more thing with these guys. So right here I'm on Seeking Alpha. So Their dividend safety is 82%, which is not bad. Okay, approximate dividend cut risk is 0.5%. Approximate dividend cut risk in pandemic level recession is 2.0%. So there were some promising things. MMP long-term dependability is 83%. So that's exceptional dependability. Overall quality, 82%. So that's pretty strong. Now, these people that do articles on Seeking Alpha is very strong. 140th highest quality master list company out of 507 is 72nd percentile. So this is something that's very good. Quality score means that it's similar in quality to such as 11 out of 12 Super Swans and Ultra Swans, Merck, Medtronic, Parker Hannifin, Coca-Cola. So they compared a lot of this stuff with these guys with their safety. So, and right here, they compared these guys with their safety score with Enbridge, EPD, TC Energy, Natural Fuel Gas, Brookfield Infrastructure, which is still pretty strong. One Oak, Kinder Morgan is actually doing better than Kinder Morgan, and MPLX. I own both of those. So that's what really attracted me to these guys. And I bought them because of this dip that's going on. And I'm going to probably, and I'm thinking about even lowering a percentage with QYLD, RYLD, and XYLD just to buy more shares of these guys. So I am messing around with my M1 Finance dividend portfolio because I was so attracted to these guys. So another thing is diversification is important. That's why I have One Oak, Kinder Morgan, and MPLX, and these guys. So now I'm a little bit more diversified with my portfolio. And it's always good to be balanced and have other sectors involved. I'm very heavy in real estate investment trusts, and I'm going to go over the third one that I want to go over with you guys because you guys really wanted me to do a review on them. And that one is Omega Health Investors. It's sitting at 30.25. It has a dividend yield at 8.86, a PE ratio of 16.71, average volume 2.18 million US dollars. The market cap is 7.12 billion US dollars. View range is 2481 to 3796. Day range is 2969 to 3035, and its previous close is 3041. So I'm going to explain to you why I like these guys and why I'm long in these guys, and I'm buying more shares in my M1 Finance dividend portfolio. So this REIT, I always tell you guys, it's very important to be specialized and be diversified with your real estate investment trust dividend portfolio. So OHI is a triple net equity REIT that supports the goals of skilled nursing facility and assisted living facility operators with financing and capital. We're partners with 64 of the most future-focused, growth-oriented operators in the U.S. and U.K., accelerating their growth strategies with $1.45 billion unsecured credit facility and proven access to the largest public equity and debt markets in the world. So I'm going to go over their portfolio. Some information regarding these guys. In 2015, they merged with the Aviv REIT, creating the largest publicly traded REIT in the U.S. dedicated to skilled nursing facilities. As of March 31st, 2022, their portfolio consists of approximately 76% skilled nursing facilities and 24% senior housing facilities, with gross investments totaling approximately $9.9 billion. Additionally, the company has invested over $5.8 billion since the merger with Aviv, with a reinvestment in new construction. So in January 2021, they acquired 24 senior living facilities from Healthpeak Properties, including closing costs. So they just have some information here. I think that's huge. So let's see what else is really good. So I'm going to go over their overall portfolio because I think that's important as well to go over some of these companies that these guys are major landlords to, because I know some of these companies. Being a nurse, I see a lot of these patients go to these companies for assisted living or skilled living. So let's go over that. Let's just start with my state. So behavioral health is huge. Canton Healthcare, the psych unit, so they're involved with psych, behavioral health, which is off the chain. Unfortunately, mental health and behavioral health is an epidemic. It's very hard to get people in facilities now. We have a lot of skilled nursing facilities in Ohio. These are the Laurels is a big one, well known. Right. Let's see, what else do we have? University Manor. I am very familiar with those guys. There are locations. Heather Hill is a very popular skilled nursing facility. Actually, I have directed patients there when they're discharged, so that one has a pretty good one. Cuyahoga Falls. When I was considering getting an STNA test out when I was going into accelerated nursing. I was going to actually do it at this assisted living facility. They teach classes for STNA certifications, but I was a privately paid sitter, so took advantage of that. So these guys are well known, and look at these skilled nursing facilities. Rose Valley is known. Brookline is another one in Pennsylvania. These guys are a big company that are well known. So a lot of these things, and here I want to address this too. Skilled nursing and assisted living, people are getting sicker. People are getting weaker. Sedentary lifestyles a lot higher. That means there's an increase in strokes. There's an increase in hypertension. There's an increase in amputations because of diabetes. So all these things adding up, and plus the baby boomers retiring, these guys are in demand as a real estate investment trust and a company. Now, people are worried about their dividend safety, but during the pandemic, people were very nervous to send their family members or to go to a skilled nursing facility because the vulnerable population, which is these people living in these facilities, they get sick. They're in big trouble, because of the bug. But now with vaccines and everything, it helps. I mean, I'm not going to say it's going to completely protect you from the bug, but you have some form of defense. And what they do now is they swab patients before they get sent to skilled nursing facilities so that there's no outbreaks and prevention of outbreaks. So they're a lot more careful than they were when the pandemic started. So this is what I like about these guys. And, I'll go over their revenue. I'll go over their dividend history as well. But this is what makes these guys very unique and what I like about them. Let's check out their revenue and dividend history. One of the most important things with real estate investment trusts, I want to see an increase in revenue. If there's no increase in revenue and the FFO's terrible, I'm not touching it with a 10-foot pole. So 2015, it was 743. This is in millions US dollars. 2016, 900. 2017, 908. 2018, a little bit of a dip of 881. Then 2019, 928. Then 2020, 892. So you could see people, oh man, I don't want to go to skilled or assisted living. And now 2021, 1,062. So there's a huge increase in revenue from 2015 to 2021, which very much attracts me. I'm going to go over a few more things with these guys. So I'm on this website, and I want to just explain to you guys FFO. What is a FFO and a REIT? A real estate investment trust defines its cash flow from operations using funds from operations and evaluating REITs and other investment trusts. The FFO per share ratio should be used instead of earnings per share. So a good FFO ratio, higher FFO to total debt ratio means the company is in better position to pay its debts from operating income and less likely to face credit risk. Company with an FFO to total debt ratio of more than 0 is considered to be a Standard & Poor's company. The risk is minimal if you have a score of 6. So we're going to go over a few things. Right here, FFO, the most recent one on Seeking Alpha is 2.94, and the PFFO was 10.34. So I just want to address that with you guys. Now let's go over their dividend history. We'll start in 2010. It was 32 cents, and then 36, and then 2010 it was 37, and then 38 cents, and then 40 cents in 2011. 2012 was 41 cents and 42 cents. Then they cracked 44 cents, and then 45 cents in 2013, then 46 cents, and then 47 cents in 2013. Wait, 48 cents, 49 cents, and then 50 cents in 2014, and then 51 cents. Then they cracked to 53 cents in 2015. Then you got a little dividend right here on 18 cents. So we have a little bit of a kink, 36 cents, and then 55 cents. So let's start in 2015. It was 55 cents, then 56 cents, then 2016, 57 cents, and then 58 cents in 2016, and then 60 cents, and then 61 cents. Then it cracked 62 cents in 2017. It finished at 65 cents. Then it was a little bit stagnant at 66 cents from 2018, 2019. Then it cracked 67 cents, and it's still stuck at 67 cents. So the payout ratio is 83%. Number of dividend increases in the last 5 years is 4. Annualized dividend growth in 5 years is 0.70%. Annual dividend slash yield is $2.68 with an 8.82% dividend yield. So this one, the dividend growth is a little bit slower, but I like the way things are going with these guys as a company, and their revenue is starting to jump up. So I just wanted to go over the FFO ratio with you guys as well. So this one, probably of the 3 dividend stocks that I reviewed, is the riskiest. So let me know what you think of this video. If you guys are new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. This is Dark Dividend. You guys have a good one, and I will post a video tomorrow for you. Take care.